Hello and welcome to this special edition of Market Masters. We are in a bull market unlike any other. Comparing the current bull market to the previous one, which is between 2003 and 2007, now actually seems a bit underwhelming, isn't it? This one feels so much bigger, more broader and wider as well. And we're doing all of this with little help from foreigners. My guest today is someone who I think is one of the best articulators, thinkers about what is going on and where we are headed. I have with me Manish Chokhani of ENAM. Manish, great to have you with us here on the program. Thank you very much.
Been a long time. Thanks for having me.
Thanks very much. Now, $4 billion a month mutual funds are getting. It's a flood out there. And by the way, it's increased. Pre-elections, pre-June elections, we were getting about $2 billion. It's now $4 billion a month. I mean, you would have thought numbers would go down. It's actually increased. Where are we headed? With the flow picture first.
Before the flow, I just want to take one step back. That as Indians, I'm just so happy that the kind of wealth creation which has happened in our country is unprecedented. And as you said, comparing it to 2 decades ago, while the percentage returns may look similar, the absolute amounts, remember we are at a $5 trillion market cap. And 85% of it is owned by Indians. There's only 15% foreign ownership. So the absolute amount of wealth creation which has happened in this bull run is just unbelievable. And hopefully it's a start of a virtuous cycle where you make the money, you reinvest it, you create more jobs and employment, you create more profits, and the cycle continues. So fingers crossed this continues. And like I said, the asset allocation mix of Indians, which we've been waiting for a long time to shift towards equity away from hard assets, is only just beginning. We are just 6 or 7% of assets are in equities. The bulk of it is still real estate and gold.
When this began, people could have argued that maybe this is a bull market phenomenon because people are chasing things, they're seeing other people make money. But this is now continued and it's actually becoming bigger.
When you see it continuing in, even through the drawdowns which have occurred, and this year we've had 2 or 3 major reasons for people to pull back. And this advent of SIPs, which the mutual fund has done an outstanding job, the whole industry, of getting people into the markets and not getting scared away at every downturn, I think is great. And remember, for context, if you remove the promoter holding, which includes the government and the 40% Indian ownership, remove the foreigners, the value of stocks with Indian investors per se is still less than the value of gold they're holding. And it's far below the value of the real estate they're holding. So it's easy to get scared away, but over the last 20 years, we never got scared that, oh my God, people might start selling gold because price is going up. And gold itself has been in a bull market during this entire episode and almost tracked the same returns as the index.
So you think this can continue? This will continue or at some point slacks off? What's your sense?
See, liquidity melt up. Remember we spoke last Diwali where I said in every decade since we broke this Bretton Woods gold standard and went to this dollar peg, we created bubbles in every decade. So in the 70s, it went to all the Nifty 50 stocks of the US. And of course, it culminated in the blowout of oil and gold and silver in that decade. Then it went to the emerging markets, which then was Japan and Taiwan in the 80s and completely blew off. In the 90s, it culminated in the NASDAQ bubble. In the 2000 to 2010, it came to BRICS, in which China was really the center of the bubble and commodities. And the last decade then went to TMT and the Magnificent Seven, which have got extended due to this excess money printing through COVID and so on. So for me, it looked like in context of history and market cycles that India would be the epicenter of the next bubble. And the conditions were ripe because the country is reaching a critical takeoff point. The economy is reasonably well governed. The entrepreneurship has been unleashed. The reforms are good. Infrastructure is getting built, both physical and digital. So, and this move that the youngsters were happier to take risk in financial assets as opposed to hard assets. So the culmination of all that still looks like we are still heading for a big melt-up. And I don't think it's over yet.
Where are we in that melt-up period?
If I knew that, I would be Warren Buffett, right? So that's $1 million answer.
But halfway through, early on...
No, look, I've been underwhelmed, to be honest, by the amount of foreign inflows. Like this year, I think we have, 15, 16 billion over a calendar. The last 12 months, maybe it's 20 billion. But 20 billion has come only through the JP Morgan debt indices.
So this year in 2024, FIs have put in about $7 billion to work. Locals have put in 39, I think, almost $40 billion.
So that's what I'm saying. The foreigners, I think, a couple of reasons, and this is just post-facto justification, because I would have expected a lot more to come in. That number one, you're making a lot of money in your home market in US. And if US is 65% of the world, and remember, it's a $65 trillion market, And if India, even after the MSCI rebalancing is reaching 3%, and the global funds don't frankly look at India, and they will start looking at now. But let's say you get the 3% market wrong and it goes up a lot. You basically drag off 1%. But you're making like a couple of percentage on NVIDIA every week over there. So I think that's one reason. The other side of the world, which is Japan, Europe, they are basically dead. So it's the flip of that is happening, that when you're dying in your home market, you're not really looking to invest abroad. So that has to happen. And it's also, I think, a reason why FDI flows have been relatively subdued. So on both fronts. Although debt flows, which we expected with the JP Morgan index inclusion and then the others to follow, those flows have started coming. So I would still expect it's not even like the first inning in a baseball game analogy of the foreign inflows into India. And the domestic flows, remember, if they keep lifting this market, they've so far only lifted what I say quadrant 4. Quadrant 1, 2 and 3, which are really the large caps, which is where the bulk of the money of the market is, hasn't yet seen massive flows. And eventually every fund manager in the world, hand on heart, is a momentum chaser. So if this market keeps performing for long, they're going to be here. Because if it were only valuations, as they all claim, then everyone would have been buying China, which is the cheapest market in the world. So I think it's a story which is unfolding. And maybe they come in through primary issuances, where again we've not had the big companies coming with big issuances, neither from the government nor from the top 10 business houses. And that becomes then an entry point to start sucking in these flows.
Actually, I was at the JP Morgan conference yesterday, and they were telling me that there are lots of investors from mainland China there.
Interesting.
Interesting. So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
it makes a major long-term top, which is not a great thing. So it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come
with new businesses
with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling, we've seen PE selling, we've seen MNC strategic selling, and it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we are a long way off from that climax, or whatever.
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. All right. Manish, we're going to take a quick commercial break here. Stay with us. We're in conversation with Manish Chokhani of Enam.